Okay, there's three things you need to know about Tuesday's huge PCE inflation report. Now, here's the thing. The Fed is going to be meeting pretty soon, and they're going to be discussing raising interest rates. Now, there's several markers that they look for. One is unemployment, and one of the other markers is the inflation rate. The PCE report is very important. It reports on the inflation. Now, here's the thing. I'm going to read you a little bit of this article. It says, the April Personal Consumptions Expenditure Report is due on Tuesday, May 30th at 8:30 a.m. Eastern Time. Now, the report has some important numbers on personal income and personal spending, but it is also the Fed's preferred measure of inflation, the PCE deflator. And recent downtick in prices has caught the Fed off guard and threatens to derail a June 14th Federal Open Market Committee hike. That's why the Tuesday report is so huge. Now, there's a couple other things happening at the same time. One of the things that's happening right now is we're going to take a quick look at the dollar index. The U.S. dollar index here is what I want you to notice is that the U.S. dollar index is dropping off. Last week it was up around 97. Now this week it's down in 96.5. Now the Fed's been raising rates. Oil prices have actually been dropping. Now, dropping oil price supports the dollar. Gold and silver prices have been remaining low. In the $17 range for silver and under $1,300 for gold is amazing. Is an amazing feat to keep the prices that low. So gold and silver prices are really low. We have low oil prices. All of this in support of the dollar and the Fed raising interest rates. They just raised the rate not long ago, 0.25 basis points. And still the dollar's dropping off. If we take a look at the dollar index over a 1 month period here, you can see it's just falling. That's not a good sign, the fact that these things are supporting the dollar, but the dollar's still falling. Now, if the Fed forgoes this next interest rate hike when everybody actually expected the Fed to raise rates, we could see something really move in the dollar. We could see the dollar drop substantially if the Fed doesn't raise rates this time, and we'll see gold prices and silver prices go up. If the Fed decides not to raise rates when everybody is priced in, they've already priced in a rate hike by the Fed in June here. They've already priced it in. And they're not expecting the Fed to go back on this rate hike. In fact, they've estimated that there's a 90% chance that the Fed's going to raise rates. This would be very unexpected if the Fed doesn't raise rates. And so the Fed, it says, this has caught the Fed off guard. Now let's take a look at what's caught the Fed off guard. It says, downtick in prices has caught the Fed off guard and threatens to derail a June 14th FOMC rate hike. This is why Tuesday's report is so huge. And you can see that the drop-off is right here. It dropped off from, it looks like it's going almost straight down. It was nearly 1.8%, and it's dropped off below 1.6%. You can see it's just dropped off a cliff right here, and just heading right down there at the core PCI. It says a weakness of year-over-year inflation numbers as they can be skewed by revisions and drop off from skews in the prior years. This is why the month-over-month numbers are also so critical. In March, core prices fell 0.1% or 0.14% rounded to the second decimal. The Fed wants to see at least 0.2 price growth each month. The consensus is plus 0.1. Personal income. The Fed and the White House and almost everyone else wants to see U.S. wage growth. It's been elusive since the crisis, as offshoring technology and the decline of organized labor, regulation, healthcare costs, and a multitude of other factors keep pay low. Well, one of the reasons why is most of these new jobs that they've created are not full-time jobs. And so they're also they're types of jobs like they're bartenders and waiters and stuff like that. And the good jobs are disappearing, the good jobs that have high pay. And this is one of the reasons why U.S. wage growth, they can't get any wage growth. So I'll read on. It says, it appears that there is no real pressure on the Fed to hike. Well, I'll tell you what, their credibility is the pressure that's on them to hike. And also, the rate hike, like I say, it's been priced in. What's going to happen? They're going to lose control if they don't start raising rates. It says the rate hikes so far have been about taking a bit of risk out of the system, creating some breathing room, and getting ahead of potential wage inflation. But what if that inflation never comes? It's a legitimate worry. The consensus estimate for health, 0.4% rise. This is baloney, what this guy's reading here. I'm calling baloney right here. He says, what if inflation never comes? I'll tell you what, buddy. The thing that's been keeping inflation back is the Fed raising rates. They're going to take, if they quit raising rates, you watch the inflation start to heat up. Because the dollar is already starting to lose some steam. The reason why there's been no inflation is we've been riding through a period since 2008 till now of moderate deflation at times, and they've been fighting this deflation. But now everything's rolled over. Everything rolled over when the bond market started to roll over, and so this whole thing is changing. The whole scheme of things is changing. The Fed, if they hold back right now, well, let's wait and see what happens in a couple weeks. But my tendency is to think that they might hold back on a rate hike, and they're gonna take the markets unawares. They're gonna if they hold back on a rate hike in the next couple weeks. Really, it's going to be something that could really excite the markets and really take some of the wind out of the sails of the dollar, because they've been pricing in a rate hike. They figure there's a 90% chance of a rate hike. And if this rate hike doesn't come, they're all going to be taken by surprise. Thanks for listening. Like and subscribe. We'll catch you in the next article. Bye.